All right, everyone, welcome back to the International Commodity Summit. We are so happy to see the energy in the morning. This is the point. It's to connect, it's to meet, it's to learn, it's to exchange and get into business with each other. So this is a wonderful thing to see. I introduced myself yesterday, but I'll do it again. My name is Manal Alansi.
Good morning, everyone. I love your energy. This is the second day of the International Commodity Summit. And today I'm joined by my co-MC, who is Manal, all the way from the States. She is the founder of Diaspora District. I'll allow her to take over. My name is Oliver. She wants me to introduce myself. Okay. So if you've just arrived, today is the second day of the International Commodity Summit right here in Cape Town, South Africa, the best seat in the world. Thank you. I'm going to hand over to Manal.
All right, so as I mentioned, we're going to kick off a wonderful day. Please keep note of who you meet to make sure you stay connected throughout the day, and we're gonna jump right into it. I would love to introduce Pieter Scholtz, COO of Digby Wells Environmental. Please give him a round of applause.
30. Who would be best positioned to control helium availability? And how should industrial buyers secure priority allocation under that structure? Unfortunately, Stefano can't be here, so we're very grateful that he agreed to send us his recording. My name is Pieter Scholtz. I'm the COO for Digby Wells. Digby Wells is a proudly African company. We're 30 years old this year. We've done about 5,300 projects over 79 countries over the last 30 years, supporting resources clients with their environmental and social compliance and impact projects. I'm going to lead this panel discussion on critical minerals. Before I ask the panelists to come up, a couple of important things first, right? What is a critical mineral? So typically we would think about critical minerals as minerals that's essential for modern technologies. Typically, they would be supply constrained or highly localized, sometimes only occurring in one country. Typically, they would be very difficult to substitute, and then they would be mostly susceptible to external risks that could disrupt their operations, whether that be economic, political, or environmental. Now, different countries have different lists of critical minerals, but typically these would include battery minerals, rare earths, PGMs, technology or semiconductor minerals. What are we looking at? Strategic industrial minerals, fertilizer minerals, and then gas-based critical resources. It's a fascinating industry, and policies across the world is currently busy reshaping the flow of critical minerals. If you think about the EU Critical Raw Minerals Act, the US's FEOC rules, and this is all happening sort of against the backdrop of resource nationalization, right? Namibia, Zimbabwe, Indonesia, examples requiring upgrading of ores in country. China now has export controls on rare earths and graphite, so quite an interesting sector to move in. And then at the same time, there's quite a bit of market volatility. After the 2023-2024 market slump, in 2025 so far, we've only really seen sort of moderate stabilization. So to help me unpack some of the questions that we need to answer from a corporate strategy perspective within this space, please welcome to the stage Nick Beukes, who is the head of the Minerals Division at AgriSA Commodities. Thanks, Nick. George Bennett, who's the CEO of Rainbow Rare Earths. And Tim George, who is the CEO of Pensana PLC. Great. James, thank you so much for your time. I'm looking forward to the discussion. I'm going to start off, Nick. Where is the real control today? Is it at the mine gate, midstream refining, or is it at logistics or financing? And then what single market change in the next 24 months could shift the control the most?
Thanks, Pieter. Yeah, look, it's a good question. I showed my son the list of critical minerals earlier, and he said to me, it looks like the whole periodic table. So, you had a good introduction there, and I think that's the reality, is that the critical mineral is effectively anything that really underpins the modern economy that we live in. So to ask the question, where's the control, I think it really depends on what you're actually talking about. So, for example, rare earths, the control lies with the refining capacity, and that's primarily China. I don't know what the exact number is, but you're looking at anything between 80 to 90% refining capacity in China, and completely dominant in the market. In terms of the other things, yeah, like I say, it's specific. So, you know, for other elements like manganese and chrome, which we deal with in South Africa, metallurgical coke, which is also on the list out of Australia, copper out of Chile, all these elements really sit with the mines, and then you have the aspect of having the logistics and finance challenges, which a trader and the whole industry normally deals with. So it's really specific to the mineral that you're looking at. I think the question is, when you're looking at each individual project and each individual element, you have to take it one by one and see where that control lies. To look at the question regarding where's it going to be in the next 24 months, look, I think the interesting thing for me personally is the big drive by the United States that's pushing for manufacturing, and like as you mentioned, the executive order that's now been put in place at the beginning of the year. The additional thing that is certainly interesting is the drive for sodium-ion batteries, which you've seen coming in lately. So that's an energy density question, which still needs to be answered, but there's a big drive out of China to push for that. So yeah, it's where the control is going to change over time. I think there's going to be interplay between what the United States does and what China does, and the manufacturing base out of Southeast Asia, and the new sodium-ion, well, we'll see how it goes, drive for basically pushing lithium-ion out. So, yeah, it's a good question. Where's the control? It can be at the mine, it can be in the logistics, and it can certainly be at the refining center, but it's specific for each individual mineral that you're looking at. So, yeah, project by project, case by case, and obviously the sources of the minerals are usually in places that you don't want to be. The refining capacities are usually in places where they have strict control limits over what they're going to do. So yeah, it's a generalized answer, but I'd say a case-by-case study on each individual thing will tell you where the control and the choke points are in the minerals.
Brilliant. So clearly, the policies in countries, what they are doing, plays quite a key role in deciding where to invest the money, where to develop. So Tim, if I can come to you, you've walked away from Salt End. What did the UK incentive mix get wrong? And what would the US need to put on the table to make Magnet Metals refinery globally competitive there?
Yeah, I mean, our project in the UK was particularly well advanced. We'd actually broken ground and had a full feed study and so on ready to go on that side of things, but the mine in Angola wasn't yet financed. And as has been pointed out, all of the feedstock for rare earth separation is largely driven through Chinese facilities. So there wasn't really an awful lot around to be able to sustain a separation facility in the UK ahead of development of the mine. So we went back to basics in terms of developing the finance package to be attractive for the mine. It was a 2-year process. We're now building that mine in Angola as we speak, aiming for production in 2027. However, the landscape of the UK changed. I think everyone can agree that politics over there have been somewhat of a roller coaster ride, and Central Treasury doesn't exactly have a huge amount of cash and a lot of competing demands for that cash. And what they were prepared to put on the table was a back-ended semi-debt grant facility, which at the end of the day didn't really contribute effectively. And then post-COVID, etc., there was a landscape of inflation that affected the sensibilities of doing that. And quite frankly, the UK and Europe have battled to get their act together with regard to critical minerals strategy. And America's woken up and is doing stuff at pace, putting in public-private financial pressure into the market and making things happen and speeding up processes, regulatory and otherwise. We're currently participating in that side of accelerated process as well to make things happen. So they've taken the bull by the horns and they're doing the things that Europe is spending too much time in committees on in Brussels, as far as I'm concerned.
Fascinating. George, you've had some fun with policy changes on as well. After the Gakara suspension, what two early warning indicators are now on your radar? And how do you structure offtakes and financing to survive a policy shock?
Yeah, look, the suspension of our small mine in Burundi by the government wasn't really that significant for Rainbow because we were already pivoting towards our project in Palabora in South Africa, which is going to be, in terms of economics, dwarf what we could ever hope to achieve in Burundi. So, and the government still hasn't come to the party there, so we're in negotiations with them to restart, but it was always going to be a very, very small revenue producer for Rainbow. Our key project is the Palabora project here in South Africa, where we're extracting the rare earths out of phosphogypsum residue stacks. And we've got a similar project in Brazil, where we're extracting rare earths out of phosphogypsum stacks in Brazil, in partnership with Mosaic, the global fertilizer business. So both those projects are the result of phosphoric acid production, which produces your gypsum residue with the rare earths in it. So, you know, for us, we focused on our Palabora project, which we started only significantly started engaging in terms of drilling those stacks and getting a resource on them in January 21. And here we are, you know, doing our final stages of our feasibility study, which will be complete next year, 2026, for that project. And of course, you know, what we did is we looked at potential, you know, strategic partners, and the US government has come to the party through a $50 million commitment by the DFC, which is the US government out of Washington, into construction equity in that project. And we know the project economics are exceptionally strong, with an EBITDA margin of circa 75%, an IRR of over 40%, you know, payback period for the plant of less than 2 years, you know, so very, very strong economics. So therefore, we attracted people like the US government via TechMet, a critical minerals fund, and that was key for us to pivot to that type of looking at that form of financing for the project. And so we know we'll have circa 2/3 of debt for the project. So the debt financing for that project starts in earnest in the first quarter of next year, hopefully complete by the end of 26 to keep our construction timeline intact, which is 27 construction to be in production in 28.
Brilliant. So if I can stay with Palabora for a moment, I have to confess I have family ties into Palabora. My history is there for generations already, so very keen to see you succeed there. If OEMs now want these 10-year index-linked offtakes with governance clauses, what must they give you in return to be able to make Palabora bankable through this entire cycle?
Yeah, well, we're looking at offtake agreements with some kind of a floor price, because we all know the Chinese pricing for these rare earths is manipulated by the Chinese, and it's not the real pricing. And since we saw the banning of export of rare earth elements, either raw elements or permanent magnets, in April this year, with the tariff wars with China, then the Chinese announced new export bans last month in October, where they specifically identified other certain rare earth elements. And then that ban they announced just a couple of weeks ago, they're going to suspend it for a year. But they're still holding the US to ransom with using rare earths as something that as a weapon. They've weaponized rare earths, the Chinese. So there's no sort of guarantee that maybe in 6 months' time they say, actually, no, we're going to reintroduce the export ban. So as Tim says, this has led to significant focus by the US government to try and get involved in financing projects to break this control that China has over rare earth elements, which are critical, as I mentioned yesterday, across every single modern technological application that you can think of has got rare earths in it at some stage. People focus on what they call the magnet rare earths, but there's a lot of other rare earths that are used in lots of other applications that people don't even realize how critical rare earths are. And I used the example of fiber optic cable yesterday. Can't make it without erbium. It's a rare earth element, and people don't even talk about erbium as being critical. They've just focused on yttrium now in the last couple of weeks as a critical component in defense. So, these rare earths go into every single conceivable modern tech that you can think of. So that's why the US is focusing on this. And Pelabora will be a project that, to a certain extent, helps create this independent supply chain outside of China. But we need floor price, to finance these projects.
Perfect. Makes perfect sense. Nick, I want to come back to you. So with these policy changes, or rather implementation that we're seeing, specifically now going back to the push for beneficiation, and then this imposing of export restrictions, which risk sharing and offtake structures actually will help keep the material flowing without blowing up counterparty risk?
Well, I think George answered it very nicely. You've got to sell to the states. I think, it really depends on who your counterparty is. The point that he just made about China having total control over the rare earths, so speaking about that, shows how difficult it actually is. And so really I always say, finding the right counterparty takes 90% of the risk out of a deal. But it doesn't always work like that in the mining space. So it's really, look, there's lots of models. There's debt equity models. Does end user invest in the actual source and supply? Does the supplier take it to an FOB component and then from there on ship it out? Lots of different models that can be applied. The key thing, I think, for taking risk out of the deal in terms of really cutting the supply chain is, what are the policies of the government, the framework policies that they implement around the resources that they control. And then that informs everyone else who's doing business in that space. So, for example, you've got things like the Indonesian nickel ban on raw ore and concentrates. Did that work? 2014, you didn't even know Indonesian nickel existed. You mentioned it when you started. Now, it's the only game in town. So what did they do? They basically banned all raw ore, anything above, I think, or under 2% nickel. And I think a few years ago, they banned all concentrates. And they essentially said, if you don't come and invest in the country, so speaking specifically to the end users, that's the Chinese, the South Koreans, and the Japanese, and build smelters and build high-pressure acid leach plants and build the necessary refineries, you're not going to get the nickel. And they incentivize those companies to come in and build those necessary plants. And so now what you have is an Indonesian nickel industry, as an example, that is dominant, supplies the world what they need in terms of nickel, and it works. I think the orangutans in the jungle might not agree with me, because I think they have some serious environmental problems. But the reality is you've got a government framework that was harsh at first, but has resulted in the fruit of a new industry that's evolved in the last 10 years that's completely dominant. So reduce the risk requires certainly from the supply side and the buyer side, they can negotiate that out. There are various different models. But the framework within which they work, the policies within they work, which is really the governments of the nation states that where those mines are, where the plants are, that's really, really important. And ensuring that it's secure and stable is the key thing. Like George just said now, if they ban it now and then they take the ban off and then 6 months later they change it again, it just causes confusion for all business people who are dealing with it. So the policy framework is certainly important. Taking the risk out is a business transaction, but the government policy is certainly important. And then I want to make another point. So Indonesian nickel, I think, generally is a success story, actually, for Indonesia. The other things that are difficult are, for example, we're dealing at the moment with a South African policy that may or may not come into play. And I mean, our two main products that come out of Southern Africa are chrome and manganese. And you've got a government policy at the moment that wants to impose a 25% export tax on all beneficiated, so that's concentrates and raw ore that's going out of South Africa. Now, no one really knows what's going on. There's been some public consultations. No one's really sure who they're going to be paying the tax to. And the primary reason to pay the tax is essentially to sustain and support the ferroalloy smelters. Whether the ferroalloy smelters are actually going to get the tax that's paid on if it's going to channel back, we don't know that either. So you've got this situation where you're in policy uncertainty, which results in business uncertainty, which essentially happens, capital is withdrawn, and people don't want to take the risks associated with just business. Mining business is hard work, no matter where you are. It makes it even harder when you don't know what the rules are of the game. So to take risk out of the transactions on a business level, I think can be done in various different agreements, offtake agreements, equity debt, that can be structured. But your framework is wrong, you're going to get a hiding.
So just to support what you're saying is that those ferroalloy smelters, I said yesterday, 6 have closed down in the last 3 years. And so it's not that people don't want to beneficiate in the country, it's because they can't, because the power is too expensive and it's not reliable. So the government's doing it the wrong way around. Rather fix the power, get the power cheap enough, those smelters will come back online. But don't put a tax on them. It's not because they don't want to beneficiate, but the government's own policies have failed in terms of keeping Eskom power down at a competitive rate where it should be, and reliable as well. Those smelters cannot have load shedding and so forth, and that's what the government should be looking at, fixing their own problems, not trying to impose a tax on it to force beneficiation. People want to beneficiate if they can.
Sorry, Pieter, just to add to that, thanks, George. So in South Africa, you have 80 ferroalloy smelters. Currently, there are 8 operating, 8 out of 80. The problem is, and it's a general problem, I think it depends, but specifically here, they're trying to treat the symptom, but not the cause. So the cause is the electricity prices. So fix that and the rest of the stuff just falls into place. So real smart policy making, and then just let the guys get on with it, really does make a difference. Indonesia's a success story. South Africa remains to be seen.
Fascinating discussion. Tim, just building now on that, right? So we have the policy uncertainty. That's going to remain a status quo for many years still, right? And then we have these minerals typically in quite difficult to work in jurisdictions. If you had $1 billion, right? I've stolen from you, where are you? If you had $1 million to maximize NDPR supply security, would you put it into transport corridors, separation capacity, magnet fabrication, or something else? And in which geography?
That's an interesting one. I mean, transport corridors, I don't think $1 billion would go an awful long way. So you're then reliant on mines that have got the ability for inbound and outbound logistics chains that make sense and can be optimized over time. Separation is probably where my bet would be on as being the critical aspect at this point in time, purely because on the
magnet side of stuff, the proximity to the market is key in terms of integrating into those supply chains. You know, generally OEMs have got their plans for magnet use 6 years in advance or so. So the lead time there in terms of development and acceptance testing of new magnets is, so that side of things is going to remain in China, where they've invested a huge amount of time as well as incentives and money in getting to the point that they are now. Japan, which has got the ongoing R&D programs, etc., with the likes of Shinetsu and others that maintain their competitive advantage globally. And then the new market or re-emerging market in the States, where it actually all started again and getting back into swing with, there are half a dozen magnet facilities going up in that side of things. So it would be in separation. The good question is where? And I mean, we're particularly looking at, rather than the cumbersome and metallurgically complex solvent extraction processes, like Rainbow as well, looking at alternative technologies which can be modularized and built out. So initially, from the risk profile, etc., in terms of the financing opportunities, that has to be started in the States. It's getting going as we speak. Particularly the last 6-7 months have been very active on that front in terms of initiatives in the States. But you know, we are looking at where we are in Angola, for example. We've got a transport system that's already there with the Lobito corridor 4 kilometers away. We've got more than enough power, water, etc. So that geographic location for that particular deposit, which is big, and we've only brought about 30% of it to book at this point in time of the drilling program that we've done, is a recipe to support a progressive reintroduction or adding on separation to that as it grows. So phase 1, which we're building at the moment, that's going to have to get processed in the States. But you know, this is where a stable mining code, as has been rolled out in Angola 8-9 years ago, and they're tweaking and improving things here and there, against a background where the oil and gas industry has thrived in that environment for decades, gives confidence to be able to make that sort of decision, where you actually understand that, you know, this is a country that understands its reliance and on natural resources, and is making plans to progressively diversify its economy and move further downstream on others, but being realistic and pragmatic about it in terms of the obligations it expects on the initial developments that are required to support those sort of downstream beneficiations.
It's fascinating to me how some countries seem to be getting this right and others don't, right? So, Nick, just coming back to you, from your trader seat, right, what are the hidden bottlenecks? So, I mean, we understand that policy certainty is a big issue, but what are the hidden bottlenecks constraining Southern Africa's critical minerals flows right now? And if you could make a policy change, what would it be?
Look, I don't think they're so hidden. I think they're pretty obvious. I thought of 3. The first one is title and policy certainty. Tim mentioned about the Angolan, mining rights and title, and that really, really is important. So what you've got in South Africa is you've got a cadastral system, which is just the record of who owns the mining rights, prospecting rights, and the titles to the mines and the minerals, which is completely opaque. No one knows what's going on. It's controlled by gatekeepers, and makes it very, very difficult to to know who has title to what. So knowing who has title, sorting out in South Africa, the cadastral system is like really, really important, and there's been a lot of promises and talk over the years, and actually nothing's come to fruition. So that has to get sorted out. The rest of Africa, if you compare it to that, so even Zimbabwe has a decent cadastral system, Tanzania, Kenya, I think even the Congo's got one now, I stand to be correct on that one. But, you know, so what they're looking at is, if you want to invest in minerals, critical minerals or other minerals, you're welcome here because we know who owns what. Okay, so that's the first thing, is who owns what, and if you own it, is it yours for the tenure that you've agreed to it? So that's really, really important for stability. The second one is, honestly, is port congestion and logistics. In Southern Africa, that's really difficult. So to get anything, any heap of stones or concentrate or refined metal from one corner to another corner of the planet is really hard. South Africa has genuine port congestion. I think Durban ranked number 3 worst in the world last year, and Cape Town and PE weren't much better. So it's difficult to get through there. You've got Tanzanian violence, political violence at the moment, so Dar es Salaam is closed. Everyone's trying to run down to Beira and to Durban at the moment. Beira is great for the Zimbabwe chrome concentrate guys because it's pretty close. They got logistics costs which are lower. But if you want to pack containers, you're going to wait 90 days. 90 days before you get on the vessel. So by that time, the market's changed twice. So there's a real logistics issue in South Africa that needs to get sorted out. Port congestion, corridors, that kind of stuff. So and that's not a hidden thing. That's just, and everyone knows that. It's just hard to fix. And then I think the last thing, which is, I don't know how they're going to fix this, but I mean, there's a real corruption problem generally. And it's like a cancer for business. So you've got, like getting a mining permit or getting your trucks out of Steelport or anything like that. All of a sudden, you have to pay permit fees. And, if you want to do good business with integrity, you can't do that. But it kind of kicks you out the game. So that's a real thing. But I don't know. I don't quite know how the guys are going to change that. But those are the 3 things that I think are real bottlenecks for unlocking the wealth of Africa. And if we can get that right, it's going to be wonderful. But if we can't, we're just going to carry on the way it is.
I don't think we're going to get the answers for that here, right? We know that those are problems that we hopefully can solve if somebody can please get the right people to help solve that. George, I'm a metallurgical engineer by qualification, right, for my sense. And the metallurgist in me wants to just change tact a little bit, right? What are the biggest unlocks that can scale rare earth supply from unconventional or secondary sources, such as tailings, clays, industrial waste? And if we do that, what are the ESG trade-offs that boards will have to accept?
Sorry, just repeat that. What, the ESG?
What are the ESG trade-offs that boards realistically should accept if we try and unlock more rare earths from these secondary sources?
Well, first of all, there are lots of projects around that are looking at rare earths from some of these secondary sources, like coal fly ash and other things. But to be honest with you, 98% of them will never get into fruition. They're not economic. So they're just they're taking advantage of the hype around rare earths, and they're getting free money for feasibility studies and pilot plants and so forth. But these processes are not really economic, to be honest with you. There are 1 or 2 that will, as I said, get into production. And if I take the Pieter example, the reason why our project works is because the grade of the rare earths, now projects running at 0.44% TREO, total rare earth oxides. Now you've got some hard rock projects in the world that are 0.52, 0.56. So we're almost as high in terms of a hard rock project. Now, as a hard rock project, you've got a lot of work to do to get it to where we are. So that's why they'll never be economic. So in a waste residue, 0.44% is very, very high grade. Some of these projects that are being bandied about, they're 0.00% TREO. So I don't see how they can be economic, to be honest with you. But from an environmental point of view, what we're doing at Phalaborwa, there's those stacks were originally built with no lining because 60 odd years ago when they were started being created, there were no environmental controls on those anywhere in the world, in fact, So environmental policies came on globally, started being bandied about only about 30 or 40 years ago. So those stacks are unlined. You've got acid water that's seeping into the ground there, making its way to the Salati River. What we're doing is we're cleaning up that acidic water, reprocessing the gypsum and putting it onto a lined stack site. So it's a big environmental cleanup. So there'll be no acid water drainage into the ground. And on top of that, we'll be selling that phosphogypsum into the South African gypsum market, slowly but surely. So over a period of 40, 50 odd years, which it took to create those stacks will eventually be level with the ground. So it's a complete environmental cleanup. And so it's got, I think, very good ESG credentials. Taking the rare earths out of like coal fly ash, it's not really environmental cleanup. I don't know much about a project like that other than just logically, so if you were successful and you could get the rare earths out of that, you still got to redeposit that coal back onto a stack, and that stack's going to stay there. So it's not environmental cleanup. The gypsum story is a very big environmental cleanup, and we're doing the same thing in Brazil, where we've got even higher grade TREO in our gypsum there. It's circa 0.56 TREO, and once again we're taking it out of phosphogypsum, and the phosphogypsum that we're taking the rare earths out of in Brazil, they're selling into the agri industry in Brazil. So that's a very good environmentally strong environmentally with ESG credentials project in Brazil as well.
That sounds fascinating. I'm going to hound you a little bit afterwards to understand more of how all of this fits together. Before I open up to the audience for some questions, Tim, just to close sort of the thinking of what is your base case versus base case type of industry value projection for non-China magnet materials by 2030? And then maybe let me just add on to that, which would be the most important KPI that boards would be tracking to decide on investment versus keeping capital back?
I think there are a handful of projects at the moment that are going to see it through in the next 5, 6 years or so, over and above the ones that are there in terms of MP, Linus, Serra Verde and others. I think projects like Rainbows make a lot of sense, but in terms of the overall balance, you need some big deposits to come through. That's one of the reasons why we focused on Longonjo. It's got 20 years of life already, with the potential to go to 35, 40, etc. Longonjo by itself, in phase one, will make about 2.5% difference in terms of contribution to the overall market. When we get through to the expansion phase, that'll be 5%. That's pretty much in the window. There are several in Australia which are going through final investment decisions and so on, which have got around similar numbers to that. So optimistically, maybe you can claw back 10 to 15% of the market realistically in the next 5 to 10 years. That obviously depends on one of the key aspects in terms of the uncertainty around China's going to behave going forward. And the key KPI that I would be looking at in all of these is OPEX. You need to be resilient. If as has happened, that price manipulation that George has spoken about is not going to go away. They've worked themselves into an admirably dominant position in this sector, and they're not going to let it go easily. So, you're going to have to stay the course, and OPEX is one of those things that is going to separate the good, bad, and the ugly in terms of the rare earth space, in terms of ambition going forward.
I mean, to support Tim, the Chinese think way ahead of anybody else in the world. I used to use a very famous quote in my presentations. 30 years ago, the Premier of China, Xi Jinping at the time, made a statement. He said, the Middle East has got oil, China's got rare earths. So 30 years ago, they recognized how critical rare earths were, and they decided to become the dominant players in rare earths, and that took them 30 years. So, when Mr. Trump says in 2 years' time we're going to be swimming in rare earths in the West, he doesn't know what he's talking about. These projects take many, many, many years to bring on stream. And as Tim says, by 2035, if we've got 20% outside of China, we'll be doing very well. But China's always going to be there, make no mistake.
So, look, it's clearly a fascinating, challenging industry. So I'm hoping I'm speaking on behalf of all of us to wish you well with the projects and the initiatives, and that they are successful. Ladies and gents, we're going to take 2 or 3 questions. Please raise your hands. And when you do ask your question, please just say to which panel member you're asking.
Thanks. So, George, yesterday, I'm Anya Kruger, CEO of Hibari, shared a panel with George yesterday, specifically where you said that beneficiation is really not an intelligent option locally. What is the quantum in terms of, let's say you were to open a smelter in South Africa at the moment? Obviously, many companies have exited the country or closed down their smelters at least and then continued mining. What is the quantum? Like, if you open a smelter in South Africa, you will make $100 a ton, but if you just sell to China, you're anyways making $90 a ton. So what gets you to that decision that in terms of the quantum, monetary amounts, that it's just a better idea to just sell the raw material to China to beneficiate?
I didn't say it wasn't practical locally. I just said locally it's not. People are talking about doing more beneficiation, but we've seen beneficiation close down in South Africa because of power costs, power and reliability of power. Not that we shouldn't be doing it. What I said about Africa, for further north, for them to keep trying to push beneficiation, it can't just happen overnight. They should rather focus on selling the concentrate to China, or like the Australians sell iron ore to China. They don't have steel smelters in Australia because they can't compete with the Chinese production costs that they can produce steel at. So rather focus on getting those tax revenues and building your local economy to eventually, maybe 20, 30 years, you can think about beneficiation. But in terms of the margin, I'm not in the smelting business. I'm not in that type of commodity where I know the margins between producing a copper concentrate and then what it costs to smelt it and then the uplift there. So I can't really answer that question, to be honest with you. What I can tell you about when I produce a copper concentrate in Burundi, our payability was 35% of the metal price. In other words, if neodymium's trading at $100 a kg, we got paid $35 a kg equivalent in our concentrate, and that was your uplift from going from concentrate to producing the metal. But the cost to go from concentrate to producing the metal is very expensive, and I'm not too sure what it is in the non-ferrous metals or the copper market is. So from that point of view, I don't really have an idea. I'm sorry.
I'd like to just add to what George said. The Indonesian nickel model is the one that I used earlier. It's difficult to beneficiate. It's difficult to add value to mineral products, and it's expensive, and it's a long-term thing. So you need a whole lot of different things to make it work. You've got to have skills. You've got to have the right infrastructure in place. Policies have to be there. Tax incentives have to be there, and it's a long-term project. So it's not just like you can open smelters tomorrow or open refineries tomorrow. There's a whole environment that must go with it, and that's not easy. It's long-term stuff. So if the country's got a long-term view on things, then add value to the products that you have. But you need the supporting infrastructure and environment to go with it. I mean, it's just obvious stuff. But if you're not prepared to do that, then it's just better just to sell the ore, because you're going to get the full value for the ore at least. and it's easy. It's easier to get an excavator and a screen and put it on the back of a truck and stick it on a vessel than what it is to do that and smelt it and make a copper cathode or copper anode later. That's hard work, and it's expensive.
Yeah, I think I support what Nick says about policy. You know, to beneficiate, these projects need to have 30 years of runway, you know, and that means massive capital investment with associated infrastructure, which I said countries need to build out before you can think about beneficiation. But we see African countries change their policy all the time, you know. I've experienced it in Burundi. I was in production in Burundi 4 years ago. The government closed me down. They wanted to renegotiate the mining convention. I've got a signed mining convention for 30 years. And now you invest on the back of that convention. Now they want to change it. So if you want to beneficiate, you're asking for Western sources of capital to invest big money into Tanzania or the DRC or wherever. Yet if you haven't got certainty of policy, why must you go and invest that money at risk that the next government in 5 years' time can just change it again? There needs to be security of policy, and they need to know if they try and change a policy, there'll be ramifications internationally. In other words, get taken to the World Court, so they won't make those changes. But until people have that certainty, why must they risk money in trying to beneficiate? You know, so governments make a statement, but they're not prepared to come to the party and give guarantees that they will not change their mind when the next president comes into power. Yes, you're right. You're taking a bet on the political integrity of that country.
All right, sorry, got another question here. It's more of a follow-up question, just out of curiosity. So I understand you mentioned that smelters are closing due to energy. I remember yesterday towards the end, there was like a big energy panel communication. So I just wanted to get an idea. Before the smelters close, do they ever consider going solar or that direction? Because I mean, if we've got so much natural heat, obviously for solar, wind down in PE, you know, they're just those kind of ideas. Obviously, it depends where the smelter is located. But if we're talking Steelport area, that area is hot. So like, have they not considered it, or is it too expensive, or what's the idea when they make a decision to close a smelter before going for renewable energy? Thanks.
I'll try to answer some of that. Yeah, guys have explored that, and I think there are some who have some solar systems in place. But you've got to have, just like we talked about security of policy, you've got to have security of supply of your ESCOM power. So at night, you're going to have ESCOM. In winter, you've got to have ESCOM at night. So yeah, look, I think they can blend it up, but it's still got to be competitive in the world market. So if you're paying 3 Rand a kilowatt hour now, but China's doing it at half that, then you might as well send the ore to China, as an example. So there's lots of solutions to that. I just think the guys are so far down the line, just generally speaking now, they're so far down the line, they've been losing money for like 5 years solid. To make new capital investments to try and be energy efficient, it's just, you know, the camel's back is broken, and I think they're just, I guess they can always do it, but I know they've looked at recycling the hot gases off the furnaces. They've tried to do that. I know some have looked at solar, and it's been partially successful, but you know, you've got to have that right energy mix blend right there, and it's got to come early, and I think, just my personal opinion, I think it's just a little bit too late now, that everyone's just a bit tired of it, and so it's just easier to do the retrenchments, unfortunately.